Hey guys, this is Lisa Church. Some of you may be employees and you may not have any desire at all to become self-employed, but I think that the following information will still be helpful for you, so stick with me. One huge difference between being an employee and being self-employed is in how you pay your income and employment taxes throughout the year. The focus of my practice in Severn, Maryland is to help taxpayers from all over the U.S. get in compliance with their federal and state tax filings and to represent them before the IRS and the states if they have a collection issue. A recurring theme that I see with my self-employed clients who have IRS collection problems is that they fail to pay their estimated taxes. So I just wanted to go over the basics of income and employment taxes. Paying income and employment taxes when you're an employee is easy since it's your employer's responsibility to withhold those from your paycheck. One of the first things that you'll do when you begin a new job is to fill out a Form W-4, which is an employee's withholding allowance certificate. The information that you provide on this form will allow your employer to calculate the amount of federal income taxes to withhold from your paychecks, as well as the state income taxes, unless you live in one of the 7 states that have no personal income tax. While the amount of income taxes withheld from your paychecks is based on your W-4, the FICA tax is a set percentage. FICA stands for Federal Insurance Contributions Act, and it's made up of a Social Security portion for retirement and a Medicare portion for hospital insurance. These FICA taxes are also referred to as employment taxes, and they're used by the federal government to pay benefits for older Americans who've already paid into the system. Approximately 7.5% of your gross income is withheld from an employee's paycheck for employment taxes, and the employer also pays another 7.5% for the employee. Keep in mind, though, that you're only paying Social Security on the first $128,400 of your wages in 2018. So if you're a self-employed person, what taxes do you need to be paying quarterly? Good question. Glad you asked. The taxes that you need to pay each quarter are called estimated taxes because that's exactly what you're doing. Estimating the amount of taxes that you're going to owe when your return is filed, and then you're sending those amounts into the IRS and to the state. These estimated taxes that you'll need to pay quarterly if self-employed are the same income and employment taxes as an employee pays, but with a few differences. First, there's no W-4 form and no employer to calculate your income taxes withheld, so you'll need to find out what your effective tax rates on your previous year's tax returns were for both the federal and the state. You just take your tax liability from the previous year as shown on the return and then divide that by your taxable income. The next difference is that you'll need to pay the full 15% of your employment taxes. While having an employer to cover half of your employment taxes is certainly a perk of being an employee, I still think that the benefits of being self-employed are greater. Another difference between the tax calculations for an employee versus those for a self-employed person is seen in the amount that's actually taxed. If you're self-employed, the amount of taxes you pay for both income and employment are calculated based on your net income after expenses are subtracted and not on your gross income collected. If you're an employee, however, these calculations are based on your gross pay. So while you pay only 7.5% in employment taxes as an employee, you're paying that 7.5% on a higher amount. Now let's look at the details. The dates that your quarterly estimated income tax payments were and are still due for your 2018 tax return are April 15th, 2018, June 15th, 2018, September 15th, 2018, and January 15th next year, 2019. While they're called quarterly payments, you can see that they're not exactly divided up evenly with 3 months in each quarter. There are a couple of different ways to think about calculating your estimated payments. If your income is uneven, with some quarters having much higher income than others, you want to make your estimated tax payment calculation using that quarter's net income. For example, for the fourth quarter estimated payment that's due on January 15th, 2019, you'll need to know what your net income was for the period of September 1st, 2018 through December 31st, 2018. If your income is earned evenly over the year, however, it would be safe to pay an equal amount each quarter. For most self-employed people, though, that's not going to be the case. You're going to have uneven income. If you want to avoid all chances of having an underpayment penalty caused by not paying enough in quarterly estimated tax payments, there are some safe harbor options that will help. The first one is if you owe less than $1,000 on your federal income tax return when it's filed. If you do owe more than $1,000 when your return is filed, however, you're still safe if you've paid at least 90% of the total tax liability shown on your current year return or the return you're filing now. For example, if your total tax liability on your 2018 federal income tax return when you file it next year is $100,000, but you made estimated tax payments of $90,000 before filing your return, you're probably not going to owe any penalties. If you don't want to be bothered with keeping up with your current year net income, there's a lazy method of paying quarterly estimated taxes. You just need to pay 100% of the total tax liability that was due on your prior year return. For example, if your total tax liability on your 2017 federal income tax return was $100,000, you could pay $100,000 in quarterly estimated tax payments for 2018 as well, and still avoid an underpayment penalty on your 2018 tax return, even if your balance due when your 2018 tax return is filed is greater than $1,000. Keep in mind that you may still owe interest on your underpayment, but you can generally avoid having to pay an underpayment penalty if you fall into one of these three situations. My goal is to help taxpayers meet their tax filing obligations, to pay the least amount of tax legally possible, and to represent them when they have an IRS or state collection issue. I have clients not only in Maryland, but from all over the world, since technology has made our world much smaller. I've given you my contact information on this last slide if you'd like to come by my home office in Severn, Maryland, or would just like to call or email me. Stay safe, try to keep warm, and I'll see you next time.